California and Florida. They're two of the most beautiful states in the US, but they're also home to a growing insurance crisis that's leaving homeowners scrambling for answers. If you live in either of these two states, you've likely seen the headlines about soaring premiums. Insurers are pulling out, and there's mounting frustration. Today, we're diving into why this is happening and what it means for you. Let's start with the facts. In California, wildfires have devastated entire communities. The most recent incident, the Palisades fire and all the engulfing surrounding fires in the LA area, which began earlier this year, they're a stark reminder of the risks that homeowners face. Investigators traced its ignition to an electrical fault, and its rapid spread was fueled by dry conditions and high winds. Early estimates suggest insurance losses from fire could exceed $25 billion, making it one of the most expensive wildfires in U.S. history. Private forecaster AccuWeather estimates the total damage and economic loss between $250 and $275 billion, which would make the LA fires the costliest natural disaster in U.S. history, even surpassing Hurricane Katrina in 2005. Thousands of families have been displaced, and entire neighborhoods are grappling with the reality of building amidst skyrocketing costs and denied insurance claims. But this is only the latest in a long history of devastating wildfires. The 2018 Camp Fire, for example, caused over $16 billion in damages and destroyed the town of Paradise. California's wildfire season has grown longer and more intense over the years, placing unprecedented pressure on the insurance market. In 2020, the state saw 5 of its 6 largest wildfires ever recorded, burning a combined 4.2 million acres. These repeated catastrophes have made insuring properties in California a high-risk proposition. Meanwhile, Florida has faced its own challenges with hurricanes, flooding, and tropical storms wreaking havoc year after year. Florida's hurricane season has been particularly brutal. In 2014 alone, Hurricane Milton caused $17 billion in insured losses, leaving a lasting impact on the state's already fragile insurance market. Residents have seen premiums double or even triple in some areas, and many are being forced to rely on Citizens Insurance, the state's insurer of last resort. Citizens now covers over 1.3 million policies, but this safety net is far from secure. If another major storm hits, the financial strain could bankrupt the program, leaving millions without coverage. It's worth noting that Florida's insurance market has been strained for decades. Hurricanes like Andrew in 1992 set the stage for a cycle of rising premiums and insurers pulling out entirely. So, why are insurance companies pulling out? It's simple: economics. When the cost of paying out claims skyrockets year after year, insurers can't afford to operate without making changes. After all, they're a business and they have to make a profit. But it's not just about natural disasters themselves. Factors like outdated infrastructure, rising repair costs, and litigation issues are compounding the problem. In Florida, frivolous lawsuits against insurers have driven up costs significantly, creating what some experts call a litigation crisis. Additionally, flood maps often fail to reflect the true risks faced by homeowners, leading to unprecedented policies that further strain the system. In California, it's a similar story, but with a unique twist. Thanks to strict government regulations, insurers can't raise premiums enough to cover the growing risk. State Farm, Allstate, and others have reduced their exposure or stopped writing new policies altogether. California's policies, while designed to protect consumers, are actually backfiring. By capping how much insurers can charge, the government is making it financially unfeasible for companies to operate in the state. These policies prevent insurers from adjusting the rates to reflect increased risks from wildfires and other disasters. One glaring example is Proposition 103, a California law that requires insurers to get state approval before raising rates. Spoiler, the state never approves it. While the intention was to keep insurance rates affordable, the reality is it's left companies unable to adapt to a changing risk landscape. Without the ability to price policies appropriately, many insurers are opting to leave the market entirely, leaving homeowners with fewer options and higher costs. The FAIR plan, a state-run insurance pool, is now overwhelmed as more homeowners turn to it as a last resort. This reliance on state-backed insurance highlights the limitations of existing reforms and the urgent need for a more sustainable approach. Looking beyond these states, the implications of the crisis are staggering. States like Louisiana, Texas, and even parts of the Midwest are starting to experience increases in natural disaster. And without proactive measures, they could be next. Severe storms and flooding are becoming more frequent in regions once considered low risk. For example, the Midwest has seen a significant uptick in catastrophic flooding over the last decade, driven by extreme rainfall events. Insurance markets across the country could face similar pressures, with reduced competition and skyrocketing premiums becoming the complete norm. So, what can be done? In Florida, efforts are underway to strengthen building codes, encourage reinsurance programs, and reduce frivolous lawsuits. These measures aim to stabilize the market, but they don't fully address the underlying risks of living in a hurricane-prone area. In California, lawmakers are debating reforms that could include allowing insurers to consider future risks when settling rates and streamlining the approval process for rate increases. Critics argue that these changes are too little, too late, but they represent a step towards a more sustainable system. On a broader scale, innovation could play a critical role in addressing the insurance crisis. Emerging technologies like satellite imagery and predictive modeling are helping insurers better assess risks and price policies accordingly. Public-private partnerships could also provide a buffer for catastrophic losses, spreading risks across a wider pool and reducing the burden on individual companies and homeowners. Additionally, blockchain technology is being explored to improve the transparency and the efficiency in the claim processing, which could reduce administrative costs and overhead and improve customer satisfaction. Innovative technologies could revolutionize how the insurance industry operates entirely, especially in high-risk areas. For example, AI-driven models can analyze vast data sets to predict areas most vulnerable to natural disasters, allowing insurers to adjust their coverage strategies proactively. Internet of Things, IoT devices such as weather sensors and smart home systems can provide real-time data to homeowners and insurers alike, reducing risks and improving response times during emergencies. These advancements not only enhance efficiency, but also help build a more resilient insurance ecosystem, capable of adapting to an increasingly unpredictable world. For homeowners, proactive measures are essential. In California, creating a defensible space around your home by clearing vegetation can significantly lower wildfire risks. Retrofitting your home with fire-resistant materials and installing ember-resistant vents are also making a big difference. In Florida, upgrading your roof, installing storm shutters, and raising electrical systems above potential flood levels can reduce your vulnerability during hurricane season. These steps not only protect your property, but they might also qualify you for insurance discounts, saving you tons of money and making your coverage more affordable. Homeowners in other states should also consider similar measures as weather patterns grow more unpredictable. In the long term, addressing this crisis requires systematic change. Insurance companies must work closely with governments to create solutions that balance affordability with sustainability. This could include developing shared risk pools for high-risk areas, investing in resilient infrastructure, or even rethinking how insurance is structured in disaster-prone regions at all. Simultaneously, greater public awareness campaigns could educate homeowners on practical steps to mitigate their risks, fostering a collaborative approach to resilience. In California, the government can be much more proactive, making sure that their reservoirs are full of water and that proper forestry techniques are taken into account, so that way we're not setting everything up for the worst case scenario. The insurance crisis in California and Florida is a complex issue with no easy answers. It's a reminder of the growing risks that we face as natural disasters become more frequent and severe. But by understanding the challenges and taking proactive steps, homeowners can navigate this difficult landscape. If you found this video helpful, don't forget to like, share, and subscribe. Let me know down in the comments below what you think about the insurance crisis and how it's affecting you. Do you think anyone's ever going to solve it? Thank you so much for watching, and I'll see you next time.